So there's been a lot of talk from the president lately about raising the capital gains tax rate from 20% to 39.4%. And it's suggested that the proposed rate will be one of the highest capital gains tax hikes that we've seen in the last 100 years. So naturally, people have started to want to know what capital gains tax rates are and how they will be impacted. Now, most people know about capital gains taxes from the real estate that they own. But guys, capital gains taxes extend well beyond just real estate. Okay, you have capital gains taxes on stocks, you have capital gains taxes on bonds, you have capital gains on business investments and the sale of business assets, and you even have capital gains tax rates on high-end jewelry. Now, here's the cool thing, okay? When you fully understand capital gains taxes, then guess what? You are able to completely avoid them, or at the very least strategize to minimize, I like that, strategize to minimize your tax liability. So in this video, what I want to do is break down exactly what capital gains taxes are, share some examples with you and some calculations with you, breaking down the numbers, talk a little bit about what the taxes pay for, and then at the end, share my personal opinion about the capital gains tax proposal. So if that all sounds good to you, then stay tuned. All right, let's go ahead and dive in by quickly explaining what is a capital gains tax. So basically, if you own an asset and that asset appreciates in value and then you sell it, you can be subject to capital gains taxes. Okay, but the key distinction here is that you're only subject to capital gains taxes once you sell the asset. And the technical term for this is when you realize a gain. Hey Sean, look, I can gain 500 pounds. Okay, kind of like that. But on the other hand, if you're holding let's say you're holding a stock, and let's say you have some Apple shares, and those shares double in value after a short period of time. Well, as long as you hold those Apple shares, even though the value went up, you won't pay any capital gains taxes because you didn't sell it. And the technical term for this is a unrealized gain because, well, you didn't make any money yet. There's no gains that you've realized. So basically, capital gains taxes are when you sell an asset that is worth more than what you paid for it. Okay, so it sounds really intense, but it's actually very simple. Now I want to go back and look at the history of capital gains tax rates. Before I do, it's really important that you know the difference between what are short-term capital gains and what are long-term capital gains. The concept again here is really simple, okay? So a short-term capital gain simply is when you have an asset and you sell it in 1 year or less. Okay, and the reason why this is so important to note is because short-term capital gains usually have a different tax rate that is applied to them. And as of right now, for the 2020 tax year, short-term capital gains are taxed as ordinary income. So basically, whatever tax bracket that you fall into, let's say you're in the 24% tax bracket, and then you sold an asset, and that asset went up in value. Well, on that short-term capital gain, remember, it's just a gain that is taxed, you will be taxed at 24%. Now let's go ahead and talk about what are long-term capital gains. Well, as you probably guessed it, a long-term capital gain is simply when you have an asset and you sell it after holding it longer than 1 year. And just like short-term capital gains, long-term capital gains have a different tax rate that is applied to them as well. And right now, long-term capital gains tax rates can be 0%, 15%, or even 20%. Okay, it really just depends on your income and your filing status. But of course, 20% is way less than 24% if you were in that tax bracket. All right, so let's do an example. As of 2020, let's say that you were single and you make $40,000 or less. You would actually have a 0% long-term capital gains tax rate. All right, now if you make $40,001 to $441,450, then your long-term capital gain rate will be 15%. And if you make $441,451 or more, then you fall in the 20% long-term capital gains tax rate. And of course, the income threshold goes up if your filing status is married, for example, because you have two people to count for instead of one. But regardless, you can see very clearly there is an incentive for people to hold their assets for more than 1 year. Because remember, short-term capital gains are taxed at ordinary income. So someone who was single in 2020 making $441,451 would pay 35% if they sold their asset in the short term, or 20% if they sold it in the long term. Hey Sean, look, I can extend my arms for the long term. Okay, so now that you have a general idea of capital gains tax, let's go ahead and look back at history. All right, now before I do, if you're new to this channel, hey, I'm Sean with Life Accounting, the accounting company that saves people from high taxes and low profit. If you're enjoying or just learning anything new from this video so far, please do us a huge favor and like this video for the YouTube algorithm so more people like you can learn about capital gains taxes in 2021. Also subscribe because we drop new videos each and every week. And while I'm at it, I just want to say thank you to everyone who has been subscribing, leaving their feedback in the comment section, and really supporting our channel. It gives us so much motivation to continue creating the videos that you guys love. Now let's go back and look at the history. So here's a chart going back to 1922, which is about 99 years ago. And as you can see, the max long-term capital gains tax rate in 1922 was about 12%. And as the economy grew and the government provided more infrastructure incentives, the capital gains tax rates grew as well. Then you see a blimp here or a bump here in the 1970s, which of course is when the United States had unprecedented inflation rates. And at that time, they needed to push asset prices down. So of course, that led to higher taxes and higher interest rates. And then for the last decade or so, you can see that we've been somewhere between 15 to 20% capital gains tax rates in the last 10 years. Now, the White House is currently proposing that we raise the max capital gains tax rate up to 39.6% if, and this is a big one, guys, if you make over $1 million a year. For those people, we edited the chart and we made a slight adjustment so you can see in comparison the tax rate that will be closer to the 40% range. Now, according to IRS data, the people who would be impacted by this, those people making more than $1 million a year, represent 0.3% of 150 million people who filed a tax return in 2018. Guys, that's not even 1% of the population. So most people who own stocks or real estate or other assets that are subject to a capital gains tax should not worry at all, and likely will still sit somewhere between a 15 to 20% tax rate on their capital gains. All right, but you still should probably know what you pay capital taxes on. So let's go ahead and talk about some assets that they apply to, and then use an example that helps us make a decision if we're faced with paying capital gains taxes. Now I want to go ahead and give you 10 assets where you can be subject to capital gains tax rates, but by no means is this a complete list. All right, these are some of the main ones that I think you should be aware of. All right, so ready, set, go. Stocks, mutual funds, collectibles, bonds, real estate, machinery, businesses, vehicles, and equipment are all subject to capital gains tax rates. All right, so that's a lot of different assets. Now let's take stocks and run some numbers for 2020 and make a decision together when we're faced with paying capital gains taxes. So let's say you bought Apple stock 6 months ago and your cost basis for that stock was $10,000. Fast forward to today, the market value of your Apple stock is $20,000. So you have a nice and even gain for this example of $10,000 after only 6 months. Now, on the other hand, let's say in the same tax year, you earn $100,000 from your other income source, and that puts you at the 24% tax bracket. So what should you do? Do you want to sell your stock or hold it? Just like the game show Deal or No Deal, the answer is almost impossible to predict, because if you sell your stock, then you are subject to a 24% ordinary income tax rate, which means of that $10,000 gain that you made in 6 months, you can only take home $7,600. But if you hold the stock and the market value remains the same, then you can move down to the 15% capital gains tax rate and keep $8,500. But on the other hand, if you hold the stock and the stock market value decreases, right? Let's say your gain went down to $7,000. Well, that is already less than the gain earlier at the $7,600 ordinary tax rate. Okay, so there's a little bit of a puzzle, a little bit of a pickle here. However, what I want to say is that most wealthy people hold stocks as long as they can and only take the money when they absolutely need it or during a year where they have no income. And that way they can get gains tax free. So they leave with the whole $10,000, and some of them are willing to hold that stock for decades to realize those gains while avoiding taxes. All right, now let's go ahead and talk about what capital gains taxes are actually used for. So in general, when we pay taxes, really any kind of taxes, it basically pays for our government services, right? Things like the military, Social Security, etc. Specifically in 2021, what the president is proposing is that we raise the capital gains taxes to do more for lower income and middle income families. Okay, stuff like raising the child care tax credits, while at the same time they want to use the money to improve infrastructure for our country so that we can make more capital gains as a country, right? So plus, we have already spent trillions of dollars in the economy, and a lot of people believe that we need to pay back some of that money that we spent by raising taxes and maybe even interest rates to get out of this deficit. Now, of course, right now I'm getting into some territory that is a little bit more reserved for like an economics professional here, but I just want to say I'm not debating whether or not we should be spending trillions of dollars or providing tax assistance to lower income families, but hopefully this just gives you an idea of why the president is proposing that we raise capital gains taxes in 2021. All right, so what are some of the outcomes of high capital gains taxes? All right, here is my personal opinion and perspective on the capital gains tax proposal. I personally think there are 3 scenarios that can come our way. Number 1, asset prices may be pushed higher because there is less supply. Okay, millionaires who want to avoid paying taxes will continue to hold their assets longer to avoid taxes. And of course, less supply means higher demand, and higher demand means higher prices. All right, scenario number 2, asset prices push lower because there is no incentive to hold assets for a long time. If the capital gains tax goes up and someone has been holding an asset that they really don't love just for the tax savings, then there is now no reason or incentive at all for them to continue holding that asset. So this could actually give millionaires more of a reason to go ahead, dump the stuff they don't like, and sell. All right, and lastly, scenario number 3 is that there is no impact at all, because we already know it's not going to impact lower or middle income class families, which makes up the bulk of economic activity. And institutional investors and millionaires have many options when it comes to reducing their overall tax liabilities beyond just holding their assets. And if the president does do some kind of infrastructure planning, he's going to need the help of corporations, investors, and millionaires to actually make that happen. And in return, I'm pretty sure they're gonna offer them tax credits and tax deductions that they're able to take advantage of. So that's probably gonna offset any capital gains taxes that they wind up paying. So that's just my thought process and the 3 possible scenarios that I see playing out out. And of course, I'm biased as a tax professional, but I believe number 3 is the most likely scenario and what I think they're planning to do. Of course, at the end of the day, for us and the average person, the biggest thing that we should worry about is focusing on increasing our incomes and decreasing our tax liabilities as much as possible with the resources that we have. So make sure you subscribe to keep getting valuable tips on how to do just that. And again, like this video if you gain any value from it at all. As always, thank you so much for watching. I'm Sean. We have some more videos coming up next, and I'll see you over there.